Hi, my name is Jill Lasek. I'm with Baird and Warner, and I wanted to talk a little bit about 1031 exchanges today. I have a investment client I'm working with right now who is doing a 1031 exchange. What is a 1031 exchange? It's really a tax avoidance code in the IRS that allows investors to buy and sell property, continually upping their gain without paying capital gains tax if they abide by certain rules established by the 1031 exchange. So you can do this, but you have to have like properties. And what does that mean? Well, the IRS is pretty open about that. They're pretty liberal, which is surprising. You could buy raw land and turn it into an apartment building. You could buy a townhome and then decide to buy a single family home. Those are considered like properties, but they have to be investment properties. You couldn't do a 1031 exchange on your own property, nor could you do it on a vacation home that you use for your personal enjoyment. It's mainly for investors that are buying like rental properties and things like that. It's something that we have to have a good working knowledge of, or at least a pretty decent knowledge of. As real estate agents, we are not experts on this. We are not tax accountants. We're not attorneys, but we need to be able to advise our clients when it's appropriate to use a 1031 exchange. There are certain rules that you need to abide by. So if you sell a property, you have 45 days to identify up to 3 properties that you're going to buy and put in the 1031 exchange. So there's an intermediary that the client will work with, and they actually take the money from the sale of the existing property. They hold on to that, and then they pay for the property that the client is going to buy the new property in. You cannot take possession of that money. It has to go through an intermediary, otherwise it avoids the 1031 exchange. So you have up to 45 days to identify 3 properties, and then you have up to 180 days to close on that property. So it's a really great tax strategy because it avoids you paying that capital gains tax and allows you to kind of kick the can down the road. And you can continually do this. You can do it as many times as you like, keep buying properties, swapping them with new ones, and avoiding that tax. The other thing I want to talk about is not only is it just for cash buyers, but you can use mortgages on these, but it has to be a minimum of what you sold. So if you say you had a $200,000 property that you sold, you have to buy at least a $200,000 property up to I think it's double. So up to $400,000 is going to be what you can swap your property with. You can use a loan, but if you reduce your principal amount on the mortgage, that is considered a gain by the IRS. So for example, let's say you had $1 million mortgage on one property, and you swapped it out for another one, and you had only a $900,000 mortgage, the IRS considers that reduction of liability of $100,000 as a gain, and you would be taxed on that $100,000 appropriately. So it's important to work with an agent that has a knowledge about this, good tax attorney, good intermediary that you can hire, and then also a good tax accountant to avoid you getting into any of these pitfalls. So if you have any questions on this, my name is Jill Lasek. I am with Baird and Warner Real Estate here in Naperville. I would be happy to talk to you about this and work with you in any regard. And please feel free to call me. My number is 630-816-8701. Hopefully everybody's having a great day and Happy New Year. Bye.